Thanks very much. It's great to be here today, I think reassuring that my peers who've presented before me equally have identified, a wide range of different investment opportunities inside South Africa that are going to offer their clients compelling returns, and I think broadly at Prudential we concur with that. This is the wildebeest session just before lunch, and hopefully, I think you can just hang on another half an hour or so, because it's going to be most of your assets are likely to be invested in South Africa. So it is kind of critical to kind of understand what the next decade is going to offer for those South African asset classes. And in my talk, I'm going to take a bird's eye view, take a little bit of a step back and echo some of the comments that you've heard already, and perhaps present some other views as well. If we start with, I guess, a scene that we'll be familiar with from July's unrest, I think this talked to the concerns and validated investors' concerns about South Africa and all that was wrong with the South African economy. And it came on the back of 5 years of very disappointing returns across many of South Africa's asset classes. And so no surprise, therefore, that investors have been pretty cautious about some of the South African assets, and why we would argue that they're going to represent compelling value in the next 5 to 10 years. Certainly, if we look at where investors have been putting their money, if we look at industry flows, then it is a doom and gloom story that seems to have been dominating their investment decisions over the last 3 years. About over 400 billion, 440 billion nearly has gone into fixed income assets, of which the vast majority has gone into cash, and cash plus, with offshore being another category that's seen positive flows. So, investors incredibly reluctant to put their money to work in South African equities or in multi-asset funds. And, has that kind of post-COVID, did that change anything? The equity market crashed, bond yields suddenly rose 3 or 4%. What did investors do? Well, actually, they continued the theme that had preceded. They continued to deploy money into cash plus investments, and see cash flowing out of South Africa into other markets that, as we've heard, are perhaps representing less great value at this point in time. So, I think actually a couple of the very early speakers that we had highlighted some of the challenges here of sitting in cash. Over the 50 years, we saw that chart from the mid-70s to now. The real value of your purchasing power if you've sat in cash in South Africa has fallen by 95%. And we also heard about compound interest, which we all kind of know about, but are you really going to compound the returns you need in some very low-yielding assets? Let's step back for a moment and look at this bonds cash story. Where is the value there? Investors in the run-up to COVID had some very reasonable real returns coming from cash. So these are the returns that investors harvested before inflation and monetary policy tightening by the Reserve Bank kind of in mid-2015 pushed real cash rates up. And really, for very little risk, investors could still get a decent return. We can see in the red line real bond yields continued to rise. And that was true post-COVID too. So with the Reserve Bank slash rates, as the South African economy slumped into a huge recession, one would normally expect that as interest rates fall, bond yields would also fall, but that wasn't what occurred. Bond yields, and this is 10-year real bond yields, continue to rise, and we can see that enormous gap that's opened up, nearly a 6% gap between the real return on cash and the real return on bonds. If you ask the question, how long will it take you to double your real purchasing power sitting in bonds at a 6% gap? The answer to that is 12 years. How long does it take you to triple that? Well, that's 20 years. And that's how compound interest is working. So It's certainly a brave investor, I would say, who is sitting there still in cash assets, and that does seem to be what the flow data has suggested investors have done. I mean, maybe investors are more concerned about equities, and that's what's keeping them out of multi-asset funds. So if we turn to that, here we're looking at the price-to-book ratio of the S&P 500, the grey line, and South African equities in red. And we've split it up into two phases, the decade after the dot-com bubble and the decade after, well, the 12 years after the global financial crisis. So, you know, what immediately jumps out is that the valuation on the S&P 500 is very similar now to where it was at the end of 1999. And that's also true, actually, of South African equities. If anything, South African equities are actually slightly cheaper on a price-to-book basis than they were then. And what we know is the decade after the dot-com bubble was a disastrous period for South African investors in US equities. The compound kind of annualized return was basically nothing in the S&P 500, while South African equities delivered 17% per annum for 10 years. Now, you know, we know that the fortunes have reversed in the last decade, but that's not the message of this chart. The message of this chart is to say, where to from here? With US equities as expensive as they are we about to kind of see a repeat of the early noughties? You know, US equities screening definitely expensive, you know, SA equities looking cheap. And from that valuation point that we'd seen, you know, back in 1999, we saw those very compelling returns. So, you know, you need to bear in mind, price is what you pay, but valuation is what you're going to get. And I'll pull together our snapshot of kind of valuation across asset classes shortly. But it is a key point, I think, that to note that I think a lot of the South African market has put its new cash or new inflows into cash and seems to be waiting for some catalyst to deploy it. You know, if this isn't one of the key parts of that narrative, then I'm not sure what is. Maybe investors are concerned about the currency, about the rand, and the press seems to be perpetually negative about what's going to happen to the rand. The newspapers are forever suggesting somehow that it's a one-way bet. And one of the reasons why historically rand volatility has been as high as it has, and that the rand has come under continued pressure whenever we have some adverse global risk event, is because South Africa has run a persistent current account deficit. And we can see here the current account deficit as a percentage of GDP. And what's fundamentally changed since COVID is we're now running material current account surplus. It's the largest surplus since 1998. Positive over 3% of GDP, and that means that actually South Africa is a supplier of global capital. We are supplying capital into global financial markets, and that massively reduces the vulnerability of the rand. And so, the notion that it's simply a one-way bet, and you need to have your money offshore for when the rand depreciates. That investment decision, and we saw that in the flows data, that investors have taken money offshore, has not worked favorably for them, because this current account situation and other factors have seen the rand depreciate significantly, leaving those global returns looking more lackluster more recently. So to pull some of those valuation indicators together, as an overall snapshot, I mean, the way that we start looking at this across asset classes is to look at what current markets are pricing, and then thinking about and comparing that to our own view of fair value. And our fair value is represented here in the kind of circles. I mean, the circles are quite large because there's some pretty decent reasons to be cautious about having a kind of point forecast. We also don't know what the future is going to be. We didn't, like everybody else in this room, forecast COVID or many other global risk events that have occurred, in my career that spanned the last 30 years. If we look at the current market pricing, that's the red bars. Those are the real returns that we think are on offer from asset classes, both South African and we've presented a couple of global asset classes on the right-hand side. And the key message in this slide is that South African asset classes are fundamentally cheap against their fair value, which is true for everything except cash. Cash is now offering you a real return that's negative. So your purchasing power is going backwards, as we saw in that long-term chart right in the early presentation. And that is a fundamental challenge for those investors. Nobody is going to, when we think about Buffett and how he accumulated his wealth, if you've got negative real returns on your assets, that compounding is working against you, and actually, as time passes, your portfolio will be worth less and less. I mean, valuation isn't like the EPO of investing. It isn't like the kind of Nike Vaporfly shoes that saw the world's fastest marathon being run. It's not that. It's not the secret sauce in a Colonel Sanders chicken. It's actually the bedrock, the foundation stone that will drive your portfolio returns in the future. So this is an absolutely kind of critical point to make, that these asset classes, from a valuation perspective, you've got it on your side in South African asset classes, and you want to support managers who are leaning into those assets. And if we look at then how those valuations are feeding through into Prudential's portfolios, our asset class preferences, thinking about both the risk and return of these asset classes on the right-hand side, South African equities and South African bonds front of stage there in terms of asset class preference. South African cash, and I think it's a theme that's been echoed time and again through this morning's presentations, South African cash materially kind of unattractive, and yet that's where the flows have gone. So investors need to think kind of hard about their asset allocation. How do we filter that through into our balanced fund? 70% of our balanced fund is invested in equity. The bulk of that comprised nearly half of the fund in local equity. That's one of the highest equity allocations that we've seen since we're kind of on a par, more or less, with where we were after the global financial crisis. And then, another fifth of the portfolio sitting in South African government bonds. Where's the residual? Well, it's sitting in foreign cash and foreign bonds, and how does that kind of make sense? Well, I think it's important to have some diversification. We definitely don't know what the future is going to hold. You want some assets that are going to protect you if the world doesn't turn out the way that you thought. And they also provide, I think, some really useful powder, dry powder to deploy as and when kind of opportunities might present themselves. So, I started with obviously the catastrophe that was the July bonfire, where I think investors came away with a view that it was likely that their asset class returns were going to be looted as a bag of carrots from a shelf in Woolworths. But if we step back and kind of look at the underlying valuations, then we can see that certainly in our view is that our balanced fund and our other portfolios are priced to deliver very compelling real investment returns over the next 5 to 10 years that will meet and, in my view, almost certainly exceed client expectations.